All right, let's talk about investing. For decades, there was a really simple playbook that pretty much everyone followed. Well, that playbook's been torn up. Today, we're going to dig into why that classic investment strategy isn't just having a bad year, it's fundamentally broken. And more importantly, we're going to look at what the new reality of 2026 and beyond actually means for your money.
Let's just start with this pretty stark reality here. The whole idea of a safe haven in your portfolio, it's been completely shaken. For as long as I can remember, the rule was simple. When your stocks take a nosedive, your bonds will be there to cushion the fall. Well, that rule is officially broken. And in this explainer, we're going to show you exactly why.
Okay, so here's our game plan. First, we'll walk through the epic failure of the 60-40 portfolio. Then, we'll get into the dangerous new rules of the bond market, decode a super important recession indicator, and then we'll pinpoint a ticking time bomb that's set to go off around 2026. And finally, we'll talk about a new way to think about building a portfolio that can actually survive all this.
All right, Section 1, the 60-40's grand failure. For generations, this was the gospel. 60% stocks for growth, 40% bonds for safety. It was that whole set it and forget it dream. But the economic engine that made that work, it has completely changed, and maybe for good.
Okay, so this really tells the entire story. For the last 40 years, we lived in a world where interest rates were mostly going down. It created this perfect seesaw effect. When the stock market got scared and went down, investors would rush into safe government bonds, which pushed their prices up. Your bonds were the perfect shock absorber. But that's over. We're now in a higher-for-longer interest rate world. The main enemy is inflation, and when central banks jack up rates to fight it, it hammers both sides of your portfolio. Higher rates are bad for stocks, and they directly crush the value of your existing bonds. The seesaw is broken. Both sides can go down at the same time.
So, if bonds aren't that simple, safe cushion anymore, what the heck are they? This is where the game has totally changed. Let's dig into the bond market's new rules and see why these safe havens have become so unpredictable.
That automatic safety net you thought you had? It's gone. And here's why. First, there's the basic math. It's called duration risk. Think of it this way. If you own a bond paying 3% and suddenly new bonds are being sold to pay 5%, who's going to want your old 3% bond? Nobody. Its price has to fall. It's suddenly yesterday's news. But the problem goes way deeper than that. You see, during scary times, people used to pile into U.S. Treasury bonds for safety. But now, we're seeing people sell them during a crisis. It's bizarre. As Deutsche Bank pointed out, treasuries aren't even moving in sync with other safe stuff like gold anymore. That tells you there's a fundamental shift in trust happening.
And check this out. It's a perfect example of what we're talking about. A tit-for-tat trade war starts kicking off, and what happens to U.S. government debt? The rates spike at a pace we haven't seen in decades. That is the exact opposite of what's supposed to happen. Turmoil is supposed to make people rush to safety, pushing rates down. This tells us that things like tariffs and geopolitics are no longer just business headlines, they are directly hitting the perceived safety of government debt, sending shockwaves right into what you thought was the safest part of your portfolio.
Okay, to really get the risk that's brewing under the surface, we have to talk about decoding the yield curve. Now, it sounds super technical, I know, but it's probably the most reliable recession indicator we've got. It's like the market firing a warning flare into the sky.
So in a normal, healthy world, it's all just common sense. If you're going to lend the government your money for 30 years, you expect to get paid a higher interest rate than if you only lend it for 3 months, right? I mean, of course you would. Your money is locked up for way longer, so you demand to be paid more for that risk. Simple.
Right. That's the key question. Because when that simple, common sense logic gets turned completely upside down, the market is sending a really powerful warning. An inverted yield curve. This is when the market will literally pay you more to borrow your money for just a few months than for 10 or even 30 years. I mean, just think about how weird that is. It means the bond market is so terrified about the immediate future that it's willing to pay a huge premium just to get its hands on short-term cash. It's basically screaming that it expects the economy to hit the skids and hard, forcing interest rates to be slashed down the road.
And listen, this isn't just some quirky economic theory. This thing has an almost perfect track record. It has shown up before every single major U.S. recession for the last 50 years. It's the storm siren for the economy. So when you see it, you know something is probably coming down the pipe.
Okay, so we have this big flashing red warning light from the yield curve. Now let's connect that to something incredibly specific and time-sensitive. Let's talk about the 2026 maturity wall. This is the ticking clock.
Just let that number sink in. $1.8 trillion.
That's trillion with a T. And that's just the amount of commercial real estate debt that has to be paid back or refinanced between 2025 and 2026. It's just one piece of a much larger tidal wave of corporate debt that's about to crash onto the shore.
They call this the wall of maturity, and it's exactly what it sounds like. Just picture all those businesses that gorged on super cheap debt back when interest rates were near zero. Well, the bill is coming due, and all of them are about to run face first into a brick wall of today's much, much higher interest rates. It's like your 0% introductory credit card rate suddenly jumping to 29% overnight, but for the entire economy.
So let's just break down the brutal truth here. You've got what's called a zombie company, a business that was only really alive because its debt was so cheap at 2%. Its interest coverage ratio, its ability to actually pay the interest, was razor thin. Now boom, it's 2026, time to refinance. The new rate isn't 2%, it's 7% or more. Their interest payments just tripled. Their ability to pay, gone. That's a death sentence. They default. And when enough of these zombie companies go down, it can start a really nasty chain reaction across the whole financial system.
So, okay, the old 60-40 map is useless. We know that. It leads you straight off the cliff we just talked about. So how do we even begin to think about building a portfolio for this new, more dangerous world? We need a new map.
This was the old world, the traditional 60-40. Super simple, clean, and based on one single idea. Stocks and bonds balance each other out. And, as we've just seen, that one idea is pretty much toast.
Now let's contrast that with a totally different way of thinking, like Ray Dalio's All Seasons portfolio. The logic here isn't about trying to predict the future. It's about being prepared for any future. It's designed so that no matter what the economy does, high inflation, deflation, booming growth, or a nasty recession, some part of your portfolio is built to do well.
And let me be crystal clear. This is not financial advice. And the point isn't to just go copy this exact formula. It's about a fundamental shift in how you think. The old model was built for one economic season. The new world requires a portfolio that's ready for all 4 seasons. And that means looking beyond just plain vanilla stocks and bonds. It's why you're hearing so much about things like active fixed income management, where professionals are making moves to manage these risks, maybe by using things like floating rate notes that actually pay you more when rates go up. It also explains the boom in things like private credit, which involves lending directly to companies, often for better returns. The game has just gotten a lot more complex. Look, in this new world of sticky inflation, if you remember only one technical thing, make it this: real yield. This is the only number that truly matters. The advertised rate, the nominal yield, that's just marketing. So your bond pays 4%? Great. But if inflation is 3%, you're only really making 1%. Your actual purchasing power only grew by 1%. And if inflation is higher than your yield, you're actually losing money every single day. You're just running on a treadmill. You have to know your real yield to know if you're actually getting ahead.
And that really leaves us with the fundamental question for every single investor heading into 2026. In a world where holding cash means you're losing money and the so-called safe investments aren't safe anymore, where do you even find true resilience? The old answers are just wrong. The path forward means understanding these new forces, because the old map simply doesn't lead to where you want to go.